This is Market Minute, the weekly brief. Before we start, nothing here is financial advice. This is a recap to give you context, not a recommendation to buy or sell anything. It was a week where the good news came with a catch. Inflation finally cooled and Wall Street exhaled until you looked at why it cooled and realized the reason was already reversing. Underneath that, a household name technology giant had the single worst day in its history. The banks quietly printed their best trading numbers ever, and a wave of takeover deals rolled across the tape. Here is what mattered and what it means for investors. The story of the tape this week was the return of the jitters. After months of one-way calm, the market started lurching again, and it did it in both directions inside the same 5 sessions. It opened badly. Monday saw the Nasdaq drop about 1.5% as technology names buckled. Then Tuesday and Wednesday clawed most of it back, before Thursday knocked the wind out of it all over again with another 1.5% slide. Added up from the prior Friday's close through Thursday, and the Nasdaq finished down roughly 1.5%, the S&P around 0.5%, and the Dow barely moved at all. A quick note on timing. Each day's paper reports the previous session, so the week's math runs Monday through Thursday's close. There was one group thriving on all this churn: the big banks. J.P. Morgan, Goldman Sachs, and the 5 largest firms on Wall Street are on pace for their best trading years ever because red-hot stock debuts and exactly this kind of volatility keep their trading floors busy. When markets get jumpy, the houses that make markets tend to win. Keep that in mind whenever calm turns to chaos. The flat headline hides the truth. This was not a calm week. It was a week of large offsetting swings, and that shift in behavior from drifting higher to whipsawing is what seasoned investors watch. Volatility tends to cluster, and it usually shows up before a change in mood, not after it. The most important number of the week was one investors had been dreading, and it came in gentler than anyone expected. Inflation, which had been running hot enough to keep the Federal Reserve boxed in, finally took a real step down in June. Consumer prices rose 3.5% from a year earlier. That is down from 4.2% the month before, and it undershot the 3.8% that economists surveyed by the Wall Street Journal had penciled in. On paper, that is exactly the cool-down the market has been praying for. New Fed Chairman Kevin Warsh spent the week on Capitol Hill telling lawmakers he has, in his words, no tolerance for inflation, and that the central bank will bring it down. A softer reading like this hands him room to eventually think about easing, and stocks nudged higher the day it landed. It is also worth noticing what did not move. Strip out food and energy, and prices were broadly flat, which is genuinely encouraging, evidence that the underlying trend is improving rather than just one lucky month. That is the piece that would let the Fed eventually declare progress. But here is the part that matters more than the number itself. Dig into where the headline cooling came from, and almost all of it traces back to one thing: gasoline. Pump prices fell hard in June, and that is doing the heavy lifting in this report, which raises an uncomfortable question about what happens when the reason for cheaper gas disappears. And this week, it did. So follow the thread. The reason gas got cheap in June was that President Trump had brokered a ceasefire with Iran, and the fear premium drained out of oil. This week, that truce fell apart. Fighting resumed, and the calm evaporated with it. Crude, which had been sitting around $71 a barrel the prior Friday, surged. It jumped nearly $7 in a single session and pushed close to $80, back to levels that put upward pressure right back into the inflation picture the June report had just relieved. At the center of it, as always, is the Strait of Hormuz, the narrow choke point that a huge share of the world's oil passes through. Iranian officials spent the week reminding everyone that the strait, in their words, will only open with Iranian arrangements. That is leverage, and the market heard it. 2 more wrinkles. The United Arab Emirates boosted its crude output by 80% in June after quitting OPEC to escape production quotas, adding a wild card to global supply. And the International Monetary Fund warned that the world economy now has less of a cushion to absorb an energy shock than it did a few years ago. For investors, the takeaway is blunt. The inflation relief you just cheered was borrowed from a ceasefire that no longer exists. For a sense of how quickly sentiment can turn on a single name, Look at what happened to IBM, a century-old blue chip, the kind of stock people buy precisely because it is supposed to be boring, had the worst day of its entire public life this week. The shares fell more than 25% in a single session, the largest one-day drop in the company's history, after it issued a rare profit warning and pointed to a sudden shift in how its customers are spending. When a company that steady breaks that hard, it tells you buyers had priced in perfection and got a jolt of reality instead. And it was not an isolated crack. SpaceX shares traded below their $135 listing price for the first time, a quiet sign that the euphoria around this year's hottest debuts is cooling. Meanwhile, Wall Street began openly warning technology companies that their historic borrowing spree to build artificial intelligence infrastructure needs to slow down. There is a deeper worry underneath IBM's stumble, and it is one investors should sit with. The company blamed a shift in customer spending, and part of what is shifting is that artificial intelligence is starting to eat into the consulting and services work that firms like IBM sell. The same wave lifting the AI winners is quietly threatening the businesses on the other side of the trade. None of these is a crisis on its own. Together they rhyme, froth showing up at the edges, in a busted profit forecast, in a marquee stock slipping underwater, in bankers urging restraint, is exactly how the late innings of a boom tend to sound. Worth watching, not panicking over. While the tape was nervous, the boardrooms were busy. This was one of the heaviest weeks for mergers and acquisitions in months, and the size of the checks tells you how much cash and confidence is sitting on corporate balance sheets right now. The eye-catcher, payments company Stripe teamed up with buyout firm Advent to make a joint takeover bid for PayPal, a deal that would value the fintech pioneer at around $53 billion. A one-time disruptor becoming a target is its own kind of signal about where power in payments is heading. There was more. Uber agreed to buy Germany's delivery hero for about $15 billion, pulling two of the world's biggest food delivery platforms under one roof. And investors led by Cotu poured $3 billion into the software firm Databricks at a staggering $188 billion valuation. The drug industry kept shopping too. Eli Lilly struck a deal to buy a mental health biotech for an initial $2.8 billion, extending a recent buying spree. While the industrial world saw Switzerland's ABB agree to acquire Britain's Rotork for around $5.5 billion. When deals cluster across this many sectors at once, it usually reflects cheap ambition meeting a fear of being left behind. But deal-making is meeting resistance. A coalition of 12 states led by California is suing to block Paramount's $81 billion acquisition of Warner Bros. Discovery, and Hollywood screenwriters joined in. The lesson for investors: the appetite to combine is roaring, but the antitrust wall is getting taller, and the biggest deals now carry real regulatory risk. The artificial intelligence race got more personal this week and a lot more expensive. It is no longer just about who builds the best model. It is about who controls the talent, the power, and the money behind it. The personal part. Apple sued OpenAI, alleging a senior executive there ran a months-long campaign to steal Apple trade secrets. When the world's most valuable company reaches for the courts, it is telling you the fight over who owns the next computing platform has turned into open combat. The expensive part. Meta scaled up its data center project in Louisiana to 5 gigawatts of computing capacity, a build it now says will cost more than $50 billion. Intel committed nearly $6 billion to expand chip-making in Ireland. The scale of this spending is why Wall Street is starting to ask out loud how it all gets paid back. And the competition keeps widening. China's DeepSeek is preparing a stock listing to fund its research, a reminder that the money-chasing AI is now global. For investors, the through line of the whole week is the same one. Enormous capital is flowing into AI, and the market is finally starting to ask what the returns will actually look like. So step back. The single thread running through this whole week is fragility, cooler inflation that leaned on a ceasefire that has since collapsed. A calm-looking tape hiding violent daily swings. A rock-solid blue chip cracking in a day. Good headlines resting on shaky foundations. Here is what I am watching next. The price of oil, because it now holds the key to whether July's inflation gives back June's gains. Whether this burst of volatility settles down or sticks around. And the next wave of earnings and deals, to see if corporate confidence holds up against a jumpier market. That is your weekly brief. As always, this is a recap for context, not financial advice, so do your own homework before you act on any of it. If it helped you make sense of the week, subscribe so the next one finds you. This is